winning strategy for an oil company depends on where you are in the overall value chain. For example, the strategy will change if you're an investor-owned major oil company versus an independent oil company versus a national oil company. And it also depends on your assets and how leveraged you are in that continuum. For example, if you're a major international oil company, you have to understand the portfolio in the current environment. You think about the price volatility that exists out there. Now is a good time to high grade the portfolio. But the way in which you do that is very, very important so that you don't exit a basin or exit an opportunity that will come back around in the future. Oftentimes, executives in oil companies, they really understand the discounted cash flow and the value of the asset under current price assumptions, under current operating assumptions. What oftentimes is missed is how does that asset fit strategically with the other parts of the portfolio? Does it connect with the pipeline assets? How does it impact your refining capability? And more importantly, are there technological options that are generated in that asset? And are there training and people options that come out of that asset? So understanding that strategic value and quantifying it's important. The next piece is trying to understand what is the market value of that asset. And so when you look at it, how would that asset fit in the portfolio of an independent oil company or a sovereign wealth investor or a national oil company or private equity investor, and the business form and structure in which that asset is put into their portfolios. If you understand that, then you can predict what the market value of that asset is. And so if you take that market value and you compare it to your operating value and your strategic value, you begin to get a sense for whether you should hold that asset in the portfolio. The final piece is really understanding the risk profile of the asset. And here is something that executives oftentimes don't get into enough detail. What they do is they think about the probable risks rather than the plausible risks. And if you go through and really understand the scenarios that could develop in holding an asset in both the catastrophic downside and the good upside, and model that and run through some more sophisticated analysis, you can value that. And then you weigh, what is the operating value, strategic value against the market value and the risk of holding that asset. And you make a better decision around how you want to keep assets in your portfolio. And it's just a better way of thinking about managing in a risky and volatile environment.